Yeah, it's been a good year so far. It's good to see everybody. I hope everyone's having a great summer. It's certainly getting warm here in Texas. Yeah, what are we expecting for the second half? I mean, as I said earlier in the year, this is the year of the rabbit. I like that because it's my year personally. I have an affinity to it. But I did expect it to be a pretty good year, and it has been. But I think there's some things that are shifting right now that we need to pay attention to. And largely that is what's driven this has been so narrow in the market. The broad market is really not doing much, but if you really narrow it down to a few sectors, that's where the growth has all been. Even today, where the NASDAQ's up pretty good, but S&P's up okay, and then there's sectors that are flat to down today. The ones that are not participating. It's really an interesting disconnect between the set. So, second half of the year. I normally don't show our full dashboard, but here's kind of a highlights. A couple of things that really caught me this week was we had small cap finally beating NASDAQ and S&P just on a relative strength basis. I typically just deal with the S&P versus NASDAQ, but it's interesting to note when small cap becomes stronger than both. It hasn't been for a long time. It's just been a mess and choppiness. Also, value for the first time in months since last year, value is stronger than growth. Now, that's not true today, and it wasn't yesterday, but when that flipped, I think 2 days ago, value's been stronger more than growth has been strong. So it's an interesting shift. And then also here we have, is it safe to be looking at leverage or not? Both right now, it's game on for everything, including the high yield are better than treasuries. So that's generally a good. These are all good things to see in the market. So expectations are it might still be good for a little while. There are a couple of seasonal things that are coming up right now that I'm iffy about, but typically July is good, and I'm not too afraid of it. The long-term trend is up. It's also a bit stretched. To go back here, that's actually what this is here is a positive, and this is the percentage stretched beyond the mean. So mean would be this line. At 2.2, it's high, but it could run for a little bit. But what you have to start thinking about is when will it snap back? And if it snaps back, will it be fast? And you have to defend very quickly. That's something to consider. Certainly the first half of July is a typically good for the stock market. And then once we get into that second half around the 20th it gets a little bit more interesting, a little bit dicier going forward. But as of right now, the money flow's going good. The trend is positive. There's really no reason not to be too defensive at the moment, other than for some seasonal reasons and depending where in the market. Our money flow, this is another one it's been positive for a while, and we've been in catching this, but it's not as good as it was back here in January when we were all in, even with leverage at times. It was, there's a lot more coming into the market. It was a little more broad. And then we had the sell-off in February to March, and then we had a good March again. But then since then, it's just been not super strong, weakish, strongish, but these are not big numbers to get you really excited about being all in on the market. But it's positive enough to want to participate. And again, that goes back to what segments of the market are being positive versus negative. And those segments are, across the board, it's largely tech, that's communications, energy, financials, industrials. Financials and industrials are fairly new to this rotation to be on the positive side. Interesting that technology was leading the way, and it's actually starting to weaken. It's got negative on the MACD for a couple of weeks now, even though it's doing all right, and it's the strong place today. And then here's our defensives that just cannot catch a break as the consumer staples. This is supposed to be the safe stuff that it's the people buy no matter what the environment. And healthcare, it's usually a defensive, but it's just not doing well either. The other one over here, utilities are also down year to date, I think 4 or 5%. They're trying, but this ADX number is pretty low. So the trend is not real strong, even though it is on the positive side as a sector. So we're looking at 9 to 2 sectors, positive to negative. Interesting in the rotation is typically these guys love to run in a circle. I like to say like ducks going around a pond, right? So they go to improve, they're leading, then they weaken, and then we have an ugly market. But what Julius de Kempener is the guy that created this, and I actually was talking with him earlier this year, and he was saying that typically if you get things going from leading into the weakening and then back up, it could be a pretty good run. And that's really what we've seen, and that's not really common, right? All the sectors kind of pushed down 2 weeks ago. You can actually check my Twitter. I post these every week so you can see where the sectors are in the rotation. 2 weeks ago or a week ago, these were all down here pushing towards lagging, and then they all kind of popped up this week, which is interesting. So this could be a final run. This could be just it was a good fake out, but now things are are getting better, certainly energy, but then we have utilities not making it. We have healthcare, nope, on the way out still. So we're still in a split market. I love seeing them all move together in a way like they did in January. In January, they all together moved from improving into leading, and it was just super easy to get onto that trend. But that's not quite where we are now, although we're seeing things pop back up. Another thing I think we referenced in our newsletter earlier this year is looking at the ratio of NASDAQ versus S&P. If the NASDAQ is stronger, that's probably more of a growth economy, which we are. It's been flat for the past, really since June, not really increasing much, but we still have red over blue. And that's looking at the last 5 days versus the past month. So 1 week and 1 month and comparing them. If the strength is going in that direction, and it still is, what we'd be concerned about is if the S&P is stronger than the NASDAQ, and that's when this is going down. This was a weak time for the markets, right? And then, yeah, last year was a lot of leaning on the S&P over the NASDAQ. So there's some great studies. Rob Hanna did one from Quantifiable Edges. Talked with him earlier this year. He just does great work about how relevant this is to keep your eye on. So as long as that stays up there, I'm good. But if this starts to turn over and the S&P is stronger, then we might be thinking about being defensive and maybe quicker. I don't normally talk about bonds, but I think it's interesting right now because I had a great conversation this week about how traditional advisors or average advisors say, you need to have 40% of your money in bonds in the bond market, and that may or may not be a good thing, especially while we're in raising interest rate environment, right? When interest rates rise, price of bonds fall. So it's not really a safe place to be. It's not really a diversifier at the moment. It doesn't really do you a lot of good. And if you look at the bonds, we've got the aggregate. This is what most people are told to buy. It's not doing great. It's really not doing. My next chart will show you the year to date. These are the 10-year treasuries, not doing great. Mortgage-backed is going to have a problem, especially with these rising rates environment. And then we have the 20-year treasury, long-term treasuries. No, you don't want to be in them either. What's working is the high yield, which is really corporate, which is more equity-like. And then what is the CW? It's the, I can't remember what it's called, but these are both more equity-based convertibles. Convertible bonds are more equity-based versus bond-based, if that makes sense, more interest rate-driven. So though that makes sense why these two are positive and these are all negative, it's just not the place to be. And then lastly, when we're looking at places, in the bond market, the blue line is the aggregate bond market, and it's not going anywhere. Sure, there's little trends. We could maybe short that. Maybe we could be long that. But this is only about a 4% move, 4% down, 4% up, and just not going anywhere. When there are so many options out there, from floating rates to ultra shorts to all the T-bills to all that, you can own these kind of things that just steadily move up. And there's really no reason to take this bond risk that's down here when you can just hang out and be in money market or short-term investments that are making 4 to 5%. There's just no reason. So you really have to be thinking about what's working at the time. And there may be a time where we take a portion of these or one of these slots and put them onto this because we're seeing a run up. And that's possible. But at the moment, play it safe. It pays too well to play it safe right now. So that's where we want to be.